I remember well the bull market of the 1970s. Those were my formative years as an investor. In that decade, 1970 to 1980, the purchasing power of the U.S. dollar, according to the then Office of Management and Budget, declined by 75% in 10 years, and the gold price ran 30-fold. A truly memorable bull market. In the middle of that bull market, many people forget that in 1975, there was finally popular outcry against inflation. And Congress and the Fed decided that they were going to break the back of inflation and increase the interest rate. They did that. And the gold price fell from $200 an ounce to $100 an ounce. And the then Philadelphia Gold and Silver Stock Index fell by 65%. And it did it in 10 months. It was a precipitous decline. If you were a young man with a quarter of his net worth in gold and gold stocks, a guy named Rick Rule.
Just any particular guy, yeah.
It was a character-building experience. And Dunnigan, I was already a character, you know. It's important to know, though, at the end of that period in 1975, because it wasn't just the gold market that got impacted. The stock market sold off. The bond market got obliterated. Housing starts basically stopped. Consumer durables that are financeable, like automobiles, fell apart. So Congress lost their nerve in a hell of a hurry. And when they took the interest rate down at the end of 1975, savers and investors in the United States and around the world understood that U.S. society capitulated in terms of keeping the dollar strong. And people who got shaken out by that 50% decline in the gold price missed out on a move from $100 an ounce to $850 an ounce in 5.5 ensuing years. I'm interested in this question because I think the political pressure in the United States right now is around another concerted interest rate drop. And that interest rate drop, given the strength in our economy, particularly relative to other economies, will signal to investors and savers around the world that U.S. society and the U.S. government is uninterested in protecting the integrity of the U.S. dollar. And I think gold's response to a real interest rate decline or a couple of 25 basis point rate cuts could be dramatic, truly dramatic. Maybe not as dramatic as 1975 was, but truly dramatic.
We have a question here about individuals. You often start with the proper couching, saying it depends on your situation, your circumstances. We can't give individual advice here, so I'll get that out of the way before we even get in there. Bob Kent 2334 says, as a percentage of liquid assets, what percentage of physical gold would you recommend holding? And I would just broaden that to say, for different types of individuals, what are the considerations that you bring to bear in thinking about that question?
It does depend on your individual situation. If most of your portfolio is in long bonds and you're a pensioner, if you're going to get whacked by inflation, you probably need 30 or 35% of your net worth inflation countermeasures, which is to say gold, silver, platinum and palladium, that kind of thing. If you're a younger person, you're a skilled person where you have inputs and you can increase your wages at the same time as the dollar deteriorates, and you have time to come back from mistakes, you can own much less. This is what I will say, Dunnigan. This doesn't need any couching. The market share of precious metals and precious metals-related securities in the United States is 0.5%, which is to say 0.5% of total savings and investment assets in the United States are comprised of physical precious metals and securities surrogates. The 4-decade mean is 2%, and I would suspect in this market we're going to overshoot that mean substantially. I have a very difficult time for most people. Well, first of all, I have a difficult time for anybody that doesn't save 10% of their income pre-tax. There's a bunch of people who want to live rich, but they don't want to get rich. And there's a contradiction there. And you need to be a capitalist to get rich. You need to have some capital to be a capitalist. You need to save to get that capital. So the first thing is save 10%, at least pre-tax. No ifs, ands, or buts. And save and invest the rest. And I believe that some portion of everybody's liquidity, but probably 20 to 25%, or depending on who you are, 50% of your liquidity should be in gold. If you save in US dollars now, which you must do, by the way, you must maintain liquidity. If you save in US dollars, you reduce your purchasing power by savings. You do it because the liquidity gives you the ability to survive and thrive in liquidity squeezes. but maintaining your purchasing power takes gold. If someone came to me and said that my portfolio is 20% liquid and half of that is in gold, which is to say 10% of their portfolio is in gold, I would say good work, nice work. Remember that if you use gold like I do as insurance, a small premium, the premium being the cost of your gold holdings, yields real benefit if the circumstance that you're afraid of takes place. If gold does what I think it could do and triple or quadruple over 10 years, a 10% gold holding can shield you from a 50% decline in the value of your securities portfolio. As an example, if your securities portfolio was half of your total portfolio, a little bit goes a long way.
If you followed my work for any length of time, you'll know I often cite Alasdair MacLeod. He's one of the sharpest thinkers in the gold space, and I have tremendous respect for his work. But let me do something I don't always do. Take the opposite side of an argument respectfully and explain why I think gold revaluation is not only possible, but perhaps inevitable. The difference between us isn't over whether the fiat experiment is ending. On that point, we agree. The difference is how the endgame plays out and whether the U.S. Treasury and Federal Reserve can engineer a way out of this sticky wicket. And sticky wicket it is, folks. Michael Hartnett at Bank of America said just the other day, central banks will be forced to revalue gold reserves to reduce domestic debt burdens. Francisco Blanch at BofA Securities followed with, gold revaluation is bullish for gold, showing it's no longer a barbarous relic. Now, when even the most mainstream analysts at one of the largest banks in the world are admitting what we in the gold community have known for years, that gold is not some pet rock but a monetary anchor, you know the conversation is shifting. Let's get into the math. Every $4,000 increase in the price of gold applied against U.S. Treasury reserves would give the Treasury General Account an additional $1 trillion of balance sheet breathing room. Gold at $10,000 an ounce would put about $2.5 trillion into Treasury hands. James Rickards has gone further. He calculates that if you divide the money supply, M1, by U.S. official gold holdings, you get a number closer to $24,000 per ounce. That would mean about $6 trillion free and clear for the Treasury. I'll come back to that, but for now, hold those numbers in your head. Now, what problem are we trying to solve? Well, let's take a hard look. By 2028, the U.S. has $28 trillion in treasuries maturing, $28 trillion in the next 3 years. On top of that, we're running $3 trillion annual deficits. Add those together, and you get $37 trillion in obligations by 2028. But our annual tax revenues are only around $5 trillion. That doesn't even cover the interest bill, let alone the entitlements, the defense budget, or anything else. So when people tell me we can grow our way out of this debt, I just laugh. We're not going to grow our way out of $37 trillion coming due in 3 years, when we only take in $5 trillion annually. You can't get there. So what's left? Inflate or default. My mentor, Richard Russell, used to say the Fed is trapped, inflate or die. And I think he was right. The most politically expedient way out is to devalue the dollar and revalue gold. This isn't some wild-eyed conspiracy theory. It's happened before. Roosevelt did it in 1933. People forget this, but when Roosevelt confiscated gold and forced Americans to hand it in, he didn't revalue gold so much as he devalued the dollar. He dropped the dollar by 40%, and that automatically revalued gold from $20 to $35 an ounce. The effect was instant. The government's balance sheet improved overnight. Nixon did the same thing in 1971 by severing the gold link, and Congress formalized it in 1972 and 1973 by moving the book price of gold from $35 to $42.22. That's still the official book price today, by the way. Wrap your head around that. The U.S. government still values its 8,133 tons of gold at $42 an ounce. That's why the gold revaluation account exists on every Western central bank balance sheet. It's a placeholder, a lever they can pull when the system needs it. Now, critics like Alasdair say, Rick, if they revalue gold to $10,000 or $20,000, wouldn't that be hyperinflation? Isn't that a deliberate act to destroy the economy? Fair point. But let's think about what's actually happening already. Since 1971, the dollar has lost over 98% of its purchasing power relative to gold. Since the pandemic, the Fed's balance sheet has doubled. Inflation has already eaten into savings, wages, and living standards. In other words, the devaluation is already happening. It's just happening slowly enough that most people don't notice, or at least don't connect the dots. That's the brilliance and cruelty of inflation. Done slowly, it's theft in slow motion. Done quickly, it becomes Venezuela or Weimar. Do I think the US will engineer a Venezuelan-style collapse overnight? Number. But I do think they'll devalue the dollar further, deliberately, to work down the debt load and to support the bond market.
What Jeff Christian will suggest is that there is no deficit because there's inventory. And strictly speaking, that's true. There is a deficit if you look at the amount of silver that's consumed every year relative to the amount of silver that is produced from silver mines or is a byproduct of other metals or is recycled. And frequently the silver bulls suggest that this deficit is so overwhelming that the silver price has to move. What those bulls neglect to point out is that there's several billion ounces of above-ground silver in inventory that doesn't have to be mined. Silver, unlike gold, is used. It's important to note that it's used in, for reflective capabilities, as an example, in solar industry. It's used in microelectronics, in regular electronics. It's also increasingly used as a germicide and in water treatment facilities. And a bunch of silver every year, goes out a tailpipe or goes up a smokestack or something like that. It goes to silver heaven.
Yeah, not to mention the silver that's in munitions and that gets vaporized when they get used, yeah.
Sure, more silver every year right now is getting used than is getting produced. But there are enormous stockpiles of above ground silver, and nobody really knows how much. I remember back to the 80s when Buffett suddenly announced that he owned 15% of the reported above ground stocks of silver. The silver price promptly doubled. All the short squeeze guys, even in the 80s, came out from under their bridges or wherever they were. And all of a sudden, the silver price collapsed. And all the silver bulls were saying, well, this must be manipulation. This must be J.P. Morgan Chase trying to screw me. What it was that there was a whole bunch of physical silver owned by the Indian peasantry. The silver price doubled in U.S. dollar terms, and the U.S. dollar doubled against the Indian rupiah. At the same time, I forget if there was a flood or a drought, one or the other, but there was a bad harvest in India, and the Indian peasantries had to make a choice between selling an asset class that was up by 400% or allowing their kids to starve. Pretty easy decision. So in the context of the question that you asked, both parts are right. There is a structural deficit in terms of new mine supply or newly created supply relative to industrial demand, but there are enormous above-ground inventories. The experience of Sprott, going back to 2014, 2015, the silver squeeze, is instructive. The narrative around silver was in full swing, and the easiest way for American investors to express their sentiment was the Sprott Physical Silver Trust. We as Sprott were able to use an at-the-market financing mechanism to convert this market activity into cash, which we used to buy silver. And for a while, we were raising $40 or $50 million a day. And our charter prohibited us from taking depository receipts. We had to take silver. So we couldn't hang around and try and buy that silver at the best price from the best taker. We cleaned out the silver that was available to us in Toronto. We cleaned out the silver that was available to us in Ottawa. We then cleaned out Chicago. We then cleaned out New York.
We talked about the U.S. Treasury's math problem and why gold revaluation is one of the only plausible tools left in the policy kit. Now let's look at the rest of the world, because if you think this story begins and ends with Washington, you're missing the larger tectonic shifts already underway. First, the BRICS. A decade ago, if you had said Brazil, Russia, India, China, and South Africa would form the nucleus of a monetary alternative to the dollar, you would have been laughed out of the room. Today, the laugh is on us. Not only have the BRICS added members like Saudi Arabia, Iran, Egypt, and others, but they are openly talking about settlement systems backed by commodities, and in some cases, explicitly by gold. Russia has already floated the idea of a unit that is partially gold-backed. China has been building the plumbing for years. the Cross-Border Interbank Payment System, CIPS, the Shanghai Gold Exchange, and multi-jurisdictional vaults in Hong Kong, Dubai, Moscow, and soon Riyadh. Now, does this mean the dollar disappears tomorrow? Of course not. The dollar will remain a major currency for years to come. But what it does mean is that for the first time since Bretton Woods, countries have a viable alternative. If you're Indonesia and you'd rather not hold depreciating treasuries, you can now do business in yuan or rubles convertible into gold. That is a sea change. Second, the physical versus paper markets. For 50 years, the gold price has been set in two places, the LBMA in London and the COMEX in New York. Both are paper markets where hundreds of ounces trade for every ounce of deliverable gold. But that system is fraying. We've already seen record deliveries out of COMEX. In some recent months, 100% of standing contracts have demanded delivery, compared to less than 1% for most of the past half-century. That's not a rounding error. That's a systemic stress fracture. Meanwhile, central banks are not stupid. They see what's happening. In 2022 and 2023, central banks bought more gold than in any year since records began in 1950. China has reported steady increases in its official reserves, and we know their true holdings are probably much higher. Poland's central bank governor was refreshingly blunt when he said, "Why gold? Because it has no credit risk." That one sentence demolishes half a century of Keynesian sneering. Third, let's deal with the myth that gold and silver are relics. If they're relics, why is China flying cargo planes around the world buying door bars and concentrate directly from mines, cutting out the exchanges entirely? If they're relics, why are the Russians redirecting their silver production to stockpiles? If they're relics, why are central banks loading up at the fastest pace in living memory? The actions speak louder than the rhetoric, and this brings us to investors. How should you position yourself in this environment? My advice is simple. Own things that can't be printed. Own things that produce cash flow, and understand the difference between price and value. Let me illustrate with a story. In 1980, at the peak of the gold bull market, my late friend Doug Casey told me that cab drivers in New York were giving him stock tips on junior miners. That was the signal the market was topping. Today, I get the opposite. I get blank stares when I mention silver or gold. People are far more interested in the latest meme stock or crypto token. That tells me we are nowhere near the top. We are still in the early innings. Another point, silver. People love to call it an industrial metal. Yes, it is used in solar panels, EV batteries, electronics, and more. But when you look at its major price swings, they always happen in tandem with gold, not copper. Silver is monetary first, industrial second. That's why when gold runs, silver outruns gold. If gold doubles, silver can triple or quadruple. That's not hype, that's history. In 1980, silver went to $50. In 2011, it went to $50 again. Adjusted for today's money supply, those numbers would be closer to $200. Now, some of you might be thinking, Rick, aren't you ignoring the possibility of outright chaos? What if this all ends in a Weimar or Venezuela-style collapse? My view is no, the US won't go full Venezuela. Hyperinflation is usually an accident of weak governance, not a deliberate policy choice of the world's largest economy. But deliberate devaluation? Absolutely, and that's bad enough. If your savings account loses half its purchasing power in 3 years, does it really matter if it's technically hyperinflation or just high inflation? You've still been robbed. This brings me back to where we started, the gold revaluation account. The US hasn't pulled this lever since the early 1970s, but the lever still exists. And when you're staring down $37 trillion in obligations against $5 trillion in revenues, you start looking for every lever you can find. That's why Michael Hartnett, Francisco Blanch, James Rickards, and others are suddenly talking about it. This isn't fringe anymore. It's mainstream. Let's close with some practical steps. If you're watching this and wondering what to do, here's my counsel. First, own some physical gold and silver. Not ETFs, not paper promises. Physical. Second, consider owning quality mining equities. Companies with real assets, real management, and real projects. This is not a space for tourists. If you don't know how to pick them, find a manager who does. Third, be patient. These things happen little by little, then all at once. When gold revaluation comes, you will not have time to buy in afterward. The market will gap higher and the window will close. And finally, keep perspective. This is not about getting rich quick. It's about protecting purchasing power in an age where governments are out of control. It's about ensuring that when the inevitable restructuring happens, you're not wiped out. Let me leave you with a tweet I saw last week. When fiat dies, gold doesn't rise. It just sits there while fiat falls. That's the whole game in one sentence. Don't think of gold as an investment. Think of it as money that doesn't lie.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.